Oh, I see that we are live. Just let me know when I should start.
Okay. Let me wait some minutes. Letting more agents to come in.
Sure, no problem.
Thank you. Hello, Winnie. Can we start the training?
Sure,
Yeah.
absolutely. Sure, sorry, I'm just waiting for you to give me the confirmation. I'll get started right now.
Okay.
Thank you.
Thank you. Yeah.
Yeah. Hi, everybody. My name is Wei Ming, and I am with Asset Preservation Inc. We are a 1031 exchange company, a 1031 exchange QI, or often called a 1031 exchange facilitator as well. So this means that the only thing we do is 1031 exchanges. We do not help clients to sell their property, to find a replacement. We're not CPAs. We're not tax advisors. So a lot of the information I give you today, they are more general information about the 1031 exchanges with some examples that you will encounter with your client as well. So without further ado, let's dive into a 1031 exchange. Well, what does the 1031 exchange code say? It says no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. That's a lot to say, and that can be very confusing for a lot of clients. But basically, what the 1031 exchange is a tax deferral strategy for you to defer up to 100% of your tax liability once you sell your property. And all you have to do is buy a like kind property. This means any property anywhere in the United States. So it doesn't matter if you sold residential, you can buy residential, you can buy commercial, you can buy land, you can buy any real property. Now, today, we're going to be talking about some of the different types of exchanges your client can use. We're going to be identifying properties that are eligible for 1031 exchanges and how you, as a real estate, can use 1031 exchanges to help you grow your business. I'm going to be talking about different points to exchanges as well and what makes it a successful exchange. And in the end, if we have any questions, I'm more than happy to take questions and go over them with you as well. Now, one of the biggest questions I get asked all the time is, Wei Ming, why do clients want to do a 1031 exchange? Or why should a client do a 1031 exchange? Well, here are some reasons. It allows your client to defer up to 100% of their capital gains taxes, and a 1031 exchange will allow your client to diversify their portfolio. What I mean by that is they can sell one property and they can buy multiple properties across different states, different cities, anywhere in the United States, or vice versa. They can sell multiple properties and buy one larger one. So for clients during COVID who sold properties in California, I have seen many clients buy in other states. For a property in California, for the value of a property in California, they could have bought two, maybe three, or even more properties out of state. So it does allow you to diversify your portfolio. What's one of the reasons for doing that? Well, it's to potentially increase your cash flow. I have a lot of clients, let's say they own a property for $1 million, they might be cash flowing 2%, maybe 3 if they're lucky on their California property. Now, with that same $1 million, they can buy more properties out of state. And I have seen a lot of clients go from having 2 to 3% return on their investment or their cash flow to over 5% out of state. So that is one potential way to utilize and maximize what a 1031 exchange can do for you. Diversify your portfolio, increase your cash flow. And again, all you have to do is buy like kind properties. That means anywhere in the United States, any type of real estate. So unfortunately, you cannot just 1031 exchange into stocks, for example. That is not eligible for an exchange. Last but not least, we have depreciation. I have many clients who have owned their properties for a long period of time. And if you are an investor yourself, you will know that when you are renting out your property, you can depreciate that property every year you rent it out or use it for business, investment, or trade use. You can depreciate that property. In short terms, that means that I'm essentially taking a write-off, getting a write-off. If I make $100,000 a year and I can take $10,000 of depreciation every year, what this means is I would subtract that 10,000 write-off from the $100,000 I make. So essentially, I'm only paying taxes on $90,000. Unfortunately, you can only take depreciation on a residential property for 27 and a half years, commercial properties for 39 years. This means that clients who have owned it for longer than that, they may not have any more depreciation. But how does that help you as a real estate agent? How does that help you to find out when a client might be looking to do a 1031 exchange and sell their property? Well, if it is getting closer to that 27 and a half years or 39 years for commercial properties. Now, if you are a real estate agent specializing in residential properties, then you're potentially looking at absentee properties where the clients are renting them out. And if they have owned it for a long period of time, 10 years, 15 years, 20 years, 25, they're coming up on that 27 and a half years. And it is a good selling point to convince clients, say, hey, you are getting close to fully depreciating your property or having completely depreciated your property already. Maybe now it's time to sell it, buy other properties of higher value with more equity, and that additional equity is now depreciable. Now, as a real estate agent, what are some of the ways that you can help yourself to identify whether or not a property is eligible for a 1031 exchange? This is what you can ask yourself. Is this property held for business, investment, or trade use? Are they operating a business out of it? Are they holding it for investment, like a rental property perhaps? Or are they using it for trade use? Do they operate their own business out of it? If they own a warehouse, are they using that warehouse to store their business goods or inventory? If that's not the case, is this property a primary residence? That is what you have to ask yourself. If it is held for business, investment, or trade use, it will qualify for a 1031 exchange. If it is a primary home, it is not eligible for 1031 exchange, but they can take a homeowner's exclusion of up to $250,000 if they're single, $500,000 if they're married, if they qualify. But wait, what if it's both? What if they rent out a part of the property and also live in it? What can they do? Well, they can both take a homeowner's exclusion and do a 1031 exchange. That is what we call a split treatment, and I will be talking about that towards the end of the presentation. But yes, you can qualify for both and you can do both at the same time. Not a problem. I see this every single month. Now, here's something you're going to encounter with your client as well. You're talking to a client trying to see if they are going to list that property with you as the real estate agent, and you want to help this client sell this property. But often than not, I have a lot of clients who will say, well, Wei Ming, how much taxes do I owe? If I owe a lot of taxes, I may not want to sell that property, right? You're going to get that a lot from clients. If I owe taxes, and I have to pay taxes, I don't want to sell my property. I may not have the money to pay those taxes. Well, what can you do? You can potentially tell them a 1031 exchange may be something that they can use to defer up to 100% of their capital gains taxes. But now that the client have that in their head, here's one of the most common misunderstanding. A lot of clients will go on Google and type, how much taxes do I owe when I sell my property? Guess what they're going to find? More often than not, they're going to find that on the federal capital gains, it's either 15 or 20%. Now they're going to go, oh, okay, I sell my property, I profit $1 million, 15 or 20% is not that bad. It's not the end of the world. Well, guess what? It's actually closer to about 33%. Huh? How did I get that 33%? Well, this is what I tell my clients. Yes, the federal capital gains tax is 15 or 20%, but that's not the only thing you owe. There's depreciation recapture tax, there's net investment income tax, and there's also state tax if that applies, right? In California, that alone is between 9.3% and 13.3%. Now, a blended average of all four of these taxes, your client is looking on average to owe about 33%. If your client is a top earner at the top of the tax brackets, they may be even closer to about 40%. So that is a great way to entice clients to utilize a 1031 exchange. Why? Because not only are you helping to sell the client's property, you're also potentially helping them to buy a replacement property. So Wei Ming, the biggest question here is, when do I pay those taxes? Well, you get to defer those taxes indefinitely. If you keep on doing 1031 exchanges, you can keep on deferring your capital gains taxes. It's only when you sell that property and don't do another exchange do you then have to pay your taxes. But why would I want to do that? My goal, if I am doing 1031 exchanges, if I am an investor, I'm going to keep on using 1031 exchanges for all my investment property. It's basically me telling Uncle Sam, I owe you tax money, but I'm going to pay you later because I'm using a 1031 exchange to defer all my capital gains taxes. Well, guess what? When I pass away, I take that with me. All the deferred taxes I have accumulated in my lifetime, that's forgiven. My heirs or whoever gets my properties from me, they don't have to pay any deferred taxes I have accumulated in my lifetime. So what does that mean, ladies and gentlemen? It means that I can keep on using this money that would have otherwise gone to taxes because I would have to pay Uncle Sam. I'm going to use all that money to buy myself better investment real estate, more investment real estate to give me a better cash flow, more passive income. And when I die, my kids don't have to pay any of those deferred taxes. There may be an estate and inheritance limit, estate tax and inheritance amount that they would have to surpass in the future to get taxed, but that's something that's to be determined in the future. But the thing about deferred taxes, that goes away, all of it. Now, ladies and gentlemen, let's take an example of what a typical 1031 exchange looks like. In this example, I bought my property for $500,000. My CPA tells me I have depreciated my property for $100,000. And I'm going to go to Jerry and I'm going to ask Jerry, hey, Jerry, I want to list my property. How much money should I spend to fix it up? It's still in fairly good condition. Jerry says about $25,000. Okay, I put $25,000 into it. I sell it and I net $1 million. In this example, how is a client going to look at these numbers and figure out, hey, how much taxes do I owe? Well, in this example, I am trying to find two things. I'm trying to find out what my adjusted basis is, and that's going to tell me how much capital gains I roughly have. Again, I bought this property for $500,000. Any depreciation I take lowers that number, but any capital improvements increase that number. So subtract $100,000 depreciation plus $25,000 of capital improvements gives me a basis of about $425,000. Jerry sells and nets me that $1 million. I subtract the 425,000. My profit is about $575,000. Now my CPA did all the calculations, and it came out to about $197,000 in a tax bill on a profit of about $575,000. Now that is just about 33%, just a little over. And that is very average for somebody selling in California. Now, ladies and gentlemen, if your client would like to do some of that or use some of that number in their own example, we at Asset Preservation Inc. have a tax calculator on our website. I have included and sent this presentation to Jerry and his team, and they can forward you a copy of the slides. But if your client would like to figure out how much taxes they can potentially be owing to Uncle Sam, well, they can use this calculator, punch in their own number, and it will give them a number very, very close to how much taxes they owe. Now, ladies and gentlemen, let's kind of go over the 1031 exchanges your client can use. There are 5 types I want to discuss. The first one is called a simultaneous exchange. Used to be the only type. This is when you close on the property that you're selling and the one that you're buying on the same day. Now, nowadays, this is extremely, extremely difficult. So what most of my clients would use, it's called a delayed 1031 exchange. This is when you close on the sale property, and from the close of escrow, have 45 days to identify potential replacement properties and a total of 180 days to close on any of the identified replacement properties. So you basically sell and have 180 days to close on a new property. In the Bay Area, I also see a lot of clients utilizing what's called a reverse 1031 exchange. This is when your client buys the new property first, and from the close of escrow, have 180 days to sell and close the property they want to sell. Basically, you buy first, sell later. The fourth type of exchange, and in my opinion, is the most versatile. It is called a construction/improvement 1031 exchange. In this type of exchange, it will allow your client to use any of the remaining money in the 1031 exchange to fix up that property that your client is buying. For example, if I need to buy a property for $1 million and I ask Jerry, can you help me find a property for $1 million? He says yes, finds me a property for $1 million, and as a really good agent, gets me that property for $900,000. It was originally for $1 million. He got it for me for $900,000. Do I give it up because it's not $1 million? Absolutely not. I'm going to buy that property for $900,000, and I'm going to use up to the one, not up to, but I can use the $100,000 to improve the property I just bought within the 180 days. Now, if I don't use all $100,000, let's say I only use $95,000, I will get that remaining $5,000 at the end of my exchange, and I will get taxed on $5,000. If we average it at 33%, that's not bad. I'm only paying about $1,700 in taxes. I'm okay with that. I defer the majority of my taxes. I'm okay with paying just a little bit. Last but not least is the reverse construction. This will allow you to buy the new property, start improving on it, and you still have within the 180 days to finish the improvements and to sell your property. So complete 180. It combines the reverse and the construction exchange at the same time. Now, ladies and gentlemen, how do we have a successful 1031 exchange? 4 things to keep in mind: property qualifications, tax deferral requirements, timeline, and identification rule. In order to qualify for a 1031 exchange, it has to be used for business, investment, or trade use. So principal residences, primary homes are not eligible. Any property that you are flipping or for development is not eligible for 1031 exchange. It has to be held for business, investment, or trade use. And you have to buy any real estate anywhere in the United States. Well, how do you defer your taxes then? 2 things to keep in mind. You have to reinvest all the net proceeds, all the cash proceeds, and buy equal or greater to your net sales price. In this example, let's say I only sell for $1 million, not net $1 million. I sell for $1 million. I still have to pay my closing costs of $100,000, and I will net $900,000. I will need to buy a replacement property for $900,000 or more to defer all my taxes. But wait, what if I have a loan? Well, if I have a loan, I will have to pay that back, but my cash is only $900,000 now. What do? Well, I will need to use the $400,000, but buy something for $900,000 or more to defer all my taxes. Well, what happens if I buy for less? If I buy a property for less, let's say I need to buy 900, I only buy for 800, I will have $100,000 left over. If I don't spend that $100,000, I'm going to get that back. I'm going to get taxed on it. Or I can spend the $100,000 on another investment property. Because remember, I can buy more than one replacement property. Or number 3, I can use that $100,000 to improve on the $800,000 property I just bought in the 1031 exchange. When I explain this concept, the most common question I get is, well, Wei Ming, I understand that I net $900,000, but I originally got this for $500, so my profit is only $400,000. Why are you telling me that I have to spend $900? Why can't I just spend the profit? Well, because the government considers it basis first, gains last. Look at this cup. In order to get to what's on the bottom, I have to finish what's on top. So basically, the government is telling me the first $500,000 I spend is the original money. And then I start spending my profits. I want to spend my profits in order to defer taxes on them. Well, if that is the case, Wei Ming, why can't I just take some of the profit? Well, if you try to take some of the profit, the government considers it profits first, basis last, meaning whatever you take is your profit first and you get taxed on it. You can't say, I want to take my original money first. You have to take your profit first if you're taking it from the sales proceeds. Now, ladies and gentlemen, again, the timeline is 45 days to identify, a total of 180 days to close on the replacement property. What do I mean by identify? We, the exchange company, will provide the client with a form. You fill out that form with the address of the property that you want to buy. If you want to make changes to this list, do it before day 45, because after day 45 passes, you cannot make changes to that list for any reason. Somebody else bought it, it's no longer on the market, whatever the reason is, after day 45, you can no longer change what's on your list. All changes and amendments have to be done before day 45. What Wei Ming? How do I identify properties then? How many properties can I list? Well, it depends which of the rules you're going to use. There are 3 rules that you can choose from. Not all of them. You choose 1 out of the 3 to use. The first rule says you can identify up to 3 properties of any value. I see a lot of clients using this if they are buying no more than 3 properties. The second rule that you can use is called the 200% rule. It lets you pick as many properties as you would like, but combined together, all those properties cannot be more than 2 times what you sell your property for. I typically see this with clients buying 4 or more properties, or I see a lot of clients use this when they buy out of state. If I sell a $1 million property in California, 2 times that amount is $2 million. How many properties can I buy, let's say in Texas or Florida, that combined is up to $2 million? I can buy 3, 4, maybe even 5 properties. So I typically see this when clients are buying a lot of properties, especially out of state. Last but not least, in the 8 years that I've been doing exchanges, I have only seen this used 3 times. This allows the client to identify as many properties as they would like, no limit to how much the property costs, but the only catch is they have to buy 95% of however much property they identify. They must acquire 95% or more of the value of all properties identified. So if I pick $100 million worth of properties, I better buy $95 million or more, or my whole exchange fails. So ladies and gentlemen, that gets me to this chart. If you have been listening and following along, even if you haven't, what I want you to get from my presentation at the very least is this chart. This chart shows what happens if a client does a 1031 exchange and does not do a 1031 exchange. What are the pros and cons? Well, the pros and cons are, if I sell my property and net $1 million, I have basis of $425. My profit here is $575,000. I'm using the same numbers I have been using throughout my presentation. If my tax rate is 33% and I do a full 1031 exchange, I'm not paying any taxes yet. I still have to pay my closing costs though, but that leaves me with $900,000. I have real estate working for me. Let me reconnect on the internet. Sorry about that. I have $900,000 in real estate working for me. So what does this mean, ladies and gentlemen? It means that, let's say, for example, I have a 5% return on my money of $900,000 a year from my property. Now, let's say I'm considering not doing a 1031 exchange. What is that going to look like? Well, all the numbers are the same, except I'm paying my taxes of almost $200,000. This leaves me with $700,000 left, a little over $700,000. Well, if I'm going to be buying real estate anyways, is it better for me to use a 1031 exchange and have 900,000, or not do an exchange and only have 700,000? Who's going to end up getting that property? The person with 900,000 or the person with $700,000? The other thing is, if I put this money in stocks, and let's say, for example, stocks is getting me a 7% return. Is 7% better than 5? Yes. Even with 7% return on $700,000, I'm making $49,000 a year. That's more than the 45, right? But wait, I have to sell my stocks in order to realize those profits. I don't get a cash flow like I do in real estate. I have to sell my stocks to get that $49,000 profit. Well, if I sell it, I have to pay taxes on that. But how I'm only making $4,000 more than I would in real estate. How long is it going to take me to recuperate and get almost $200,000 back? If I wanted to, I can always refinance my $900,000 property and pull cash out. Can I refinance stocks? No, I can't. I have to sell it. So this is an illustrated example of what happens when somebody does a 1031 exchange and when somebody don't do an exchange. They have less purchasing power. They have less to invest. Now, ladies and gentlemen, I want to quickly talk about a split treatment. And this is something that you're going to see quite a bit. In this example, let's say I can sell my property and I can net $1 million. And in this example, I originally bought it for 400, so my profit is $600,000. If I'm married and I qualify for homeowners exclusion, I can take $500,000, right? Everybody knows that. I can take $500,000, but this leaves me with $100,000 left that I have to pay taxes on. Well, you as the real estate agent, you're going to see that your client is going to tell you, if I have to pay taxes, I don't want to sell at all, right? Well, there's no way around it. They have to pay their taxes. It's their primary home. But if I know that my client is going to sell the property in the near future, I could potentially tell my clients, maybe rent out a part of your property. In this case, the client rents out half this property. Well, guess what? Half of this property qualified for a homeowner's exclusion, half of it for a 1031 exchange. It's 50-50. So I split everything in half. The net sales price, split in half. The basis, split in half. The gains, split in half. So the primary portion only made $300,000. The rental part made $300,000. Again, if I'm married, I can take up to $500,000. So the $300,000 exclusion on the primary portion, I don't pay taxes on it. And the other $500,000, I can do a 1031 exchange on that portion. What does this mean for you as a realtor? Well, if your client might be looking to downsize, this is a perfect example. They can take $500,000 and go and downsize on their property. They can also do a 1031 exchange for $500,000 on the rental property portion and buy an investment property. Not only have they downsized, they didn't have to pay a single penny in taxes, and now they have an investment property on the side, giving them a cash flow in their retirement one after they have downsized into whatever property they've downsized to. And ladies and gentlemen, it doesn't have to be 50-50. The client can live in 75%, rent for 25. The number is going to change a little bit, but it depends on how much gain they have. They can plan ahead. They can plan early so that they don't have to pay anything at all when they sell their property. So in this case, if I rent out 100%, my replacement property is $500,000 or greater, right? So I have these examples that you can make references to when you get a copy of these slides. And ladies and gentlemen, once a client completes a 1031 exchange, they do file this form, a 2-page form, along with their tax return. It asks them about their 1031 exchange. Address of the property they sold, address of the property they bought, when did they sell, when did they buy, and all those numbers. The CPA will be helping them to file this form, or if they don't have one, they can file it themselves if they want. But this lets the government know everything about the 1031 exchange. If your client did not do a full 1031 exchange, there's some taxes to pay. This is how the government finds out and knows. How does the government know your client is deferring all their taxes? Exactly this form. This form lets them know they bought equal or greater in value, so they don't owe Uncle Sam any tax money. Now, ladies and gentlemen, that concludes the presentation on 1031 exchanges. I understand that was a lot of information, and I am happy to take any questions that you may have. Let's see. I am happy to take any questions that you may have, or any specific examples you may want to go over. Does anybody have any questions? Okay, it looks like I have a question. Go ahead. Feel free to type out that question in the box, or here.
Hello, yeah, I have a question for you.
Yes.
That for the property tax, if you don't do 1031 exchange, the tax rate is 33.33%?
Yes, on average. I'm just averaging the potential tax rate. And that's in California, by the way. I have seen anywhere from about 30 to 40% if you're selling in California. If you're selling outside California, where, let's say Texas, where there's no state tax, your average might be closer to about 25. It could range from about 25 to 40% is what I'm saying.
Oh, that's pretty high tax, almost half of it.
Yeah, and it's based on your tax bracket as well. Depreciation recapture tax is 25%. However much you depreciated your property so far, federal taxes is 20, and state taxes, again, state like like Texas could be 0, or it could be in California where it goes up as high as 13.3.
Okay, and also I have another question: is any like how long, if like for example your primary residence, you live in some and rent some out, and in that case if you do 1031 exchange, there's any require like you how long rented to tenant property? For example, like you need to have the tenant there for 2 years or 3 years, how that time, you know?
That is a good question. The question is, how long does the property need to be rented out to qualify for an exchange? You will hear a lot of answers. You will hear 1 year, you will hear 2 years. What is the official answer? The official answer is there is no time specified in the Internal Revenue Code. You hear 1 year and you hear 2 years is because that's what a lot of CPAs will recommend as like a safe harbor. What is safe? What is conservative? It's the equivalent of me saying, hey, let's go for a jog. If I take 10 steps, that's technically a jog, or I can really go for a jog and jog 2-3 miles, right? That's real exercise. But is 10 steps still count? Yes, technically it does. But is the government going to accept that? Probably not. You can rent your property out for 1 week and call it a rental, but the government probably won't accept that. So that's why a lot of CPAs will say 1 year or 2 years. 2 years or longer is preferred, but I have seen minimum about 1 year.
Okay. So for example, you have 4 rooms, you just rent 1 room out, still count like half?
No, it's however you report it on your tax return. So if the 1 room accounts for 10% of the total square footage of the home, then it's 10%. Right? If I rent out half this property, I'm going to need to count the square footage. CPAs will not count shared space. It's only space dedicated specifically for the tenant. So I could rent out, bottom half of my house and I live in the top half. I can rent out the ADU or in-law unit and I live in the main house. I could, if I have a duplex, I can live in 1 unit, I can rent out the other unit. So there's a lot of uses, and it doesn't have to be 50-50.
There's any evidence you need, for example, for you prove you have half of your house rented to the tenant?
Yes, lease agreement and rental income is typically what the auditor would ask if there's ever an audit. Not that your client will get audit, but if there is, that's what the auditor would ask.
Can you rent it to your relatives?
Absolutely. You can rent it to your kids. You can rent it to any family as long as they're of legal age to sign. You just cannot rent to yourself or to your spouse.
Okay,
So,
and also you need to prove you have fund coming in every month too, right?
Potentially. Sometimes, this is rare, but occasionally I have clients who will let their kids pay at the end of the year rather than pay everything upfront or pay month to month, especially if the kids may not have those funds.
Okay.
Yeah.
Okay. So is that they need to qualify the name exactly? Need to match the name who is rent the property?
No. So I'll give you an example. If you are my landlord, I rent from you. I rent from you. I don't even have to use the property at all. But the fact that I rent it from you, I have a lease agreement with you and I pay you rent, that's good enough. Do I have to live in that property? No. I can let let's say, for example, my parents live in it and I still pay you rent. That's fine. As long as you can show a lease agreement and rental income, if there's ever an audit, you're pretty set.
Okay. For the rental income, they need to verify the money come from the lease. I mean, like a tenant.
That I'm not 100% sure. Sometimes they will ask, sometimes they won't. I have seen clients have their auditor ask either one. Doesn't really matter how the money comes in necessarily. I have had clients who rent it and they get it in cash and they're just going to report the rental. Governments really care about collecting their tax money anyways, right? They may not necessarily care that it's in cash or it's in a check, as long as they're reporting it and it's fair market value. So you should not be expecting to rent to kids or relatives for $1 or $100 a month. It's got to be fair market value or close to it.
Okay, I see. Thank you.
Yeah, absolutely. Anybody else have any questions?
Hey, Mr. Peng.
Yes, sir.
Hi, this is Tom. Thank you for the presentation. I have a quick question here. I saw that you mentioned 121 about the percentage of the rent on your email. Can you just elaborate a little bit more about what is the 121?
Got it. So the homeowner's exclusion It says if I have lived in the property for 2 out of the last 5 years, any of those last 5 years, I can take up to $250,000 tax free if I am single, $500,000 if I'm married. So what this means is let's only look at these three numbers that you can see on the screen. I net $1 million. I originally bought my property for 400,000. Let's say this is my primary home. My profit, you can see, is $600,000. If I'm married, I can take 500,000 of the 600 tax free. So I am only left with $100,000 that I have to pay taxes on. So the homeowner's exclusion knocks out a lot of the profit that I have to pay taxes on. But I was using this example because what if I have more than 500? Because you're going to have clients that's going to say, oh, I have some taxes to pay that I don't want to sell, right? So in that case, what's a good example of using the up to the 500,000 and also using a 1031 exchange so they don't pay anything at all? So that was the example I was giving.
Okay, thank you, Mr. Peng. I have another question here. Do you have any contact number and with you or your company to present? And what if I need a consultation from my personal condition situation versus, follow up?
Jerry has my contact information, but if you look on the screen, the best way to reach me is my cell phone, and this is my email. Cell phone is the fastest way to reach me. You can text me, you can call me. I'm more than happy to go over the information with you and go over your scenario, run the numbers with you as well, so you get all that in writing.
Thank you.
Yeah, absolutely.
So for the exchange, how long takes?
How long would it take to set up?
Yeah, set up and yeah.
So in a regular 1031 exchange, we can get this set up in 24, 48 hours. So fairly quickly. Ideally, give us more time so we can look over the paperwork, make sure everything's okay. Because we don't want to find problems with the title report at the last minute. We've had that before. But we want to make sure that we tell the client there's any issues or any problems before it's too late. So yes, we can get it set up fast, but give us a little bit of time to look over everything.
Okay, are you guys do residential and commercial?
I'm sorry?
Are you guys doing commercial too?
Yes, we do any and all real estate, residential, commercial, land, any type of real estate.
Oh, I have another question is if you sell the house, can you buy commercial? Or if you want, you did sell residential, can you buy commercial or buy land, like different type of, or farm, different type of properties?
Yes, you can sell any type and you can buy any type as long as it's in the United States. So I can sell a condo and I can buy a commercial if I want. I can sell land, I can buy commercial. I can sell commercial and I can buy a condo, a townhome, a residential property, a duplex, multi-unit, whatever I want.
But the owner's name must be same, right?
Owner's name or the taxpayer will have to be the same, but you can also buy with other parties as well. So let's say I sell a property for $500,000 and I want to buy for $1 million. I want to buy with Jerry. Okay, Jerry and I are not related. We're just going to buy a property together. If that's the case, I put 500,000. He puts 500,000. We buy for 1 million. Great. He's on title 50%. I'm on title 50% as tenants in common. So I can buy with anybody I want to as well.
Okay, for example, if you are the owner, before you use your personal name, right now you have LLC or trust. Can you treat as not use your own name, use your trust or your LLC instead of your your personal name.
That is okay as long as the entity is set up as a pass-through entity disregarded for tax purposes. So whoever is helping you to set that up, tell them and make sure that it is set up as a pass-through entity. Then that's okay.
What do you mean pass-through entity?
So I'll give you an example. I sell in my name, I set up LLC, and I'm the only member. I buy new property under LLC, no problem. Now, if Jerry and I want to buy together, we have to be tenants in common. Jerry and I cannot form an LLC and buy the new property under LLC. That's not a pass-through. Because two separate taxpayers together like that are not married, then it becomes a totally new taxpayer. The entity is the taxpayer. It's not me. It's not Jerry. The entity is the taxpayer. So
your point is it can be, but you need to be a manager or trustee on the LLC or trust company, family trust, right?
Not necessarily. It can get complicated, but depending on the situation, let me know how you want to set it up, and I can let you know if it can be done.
Are you guys only doing California or all America?
Anywhere in the United States.
Oh, cool. Thanks.
Hey, Mr. Peng,
Yes, sir.
how to identify as the primary residence? For example, if I'm currently living in there as my primary, so I plan to rent it out. I just live somewhere else now. Is there any time limitation that I can claim the previous address as the rental property? If I've just moved out of this month, I just want to claim that right now.
Yeah, well, if you move out this month and you claim it, then ideally from the day that you have it as a rental, have at least a year before you do an exchange, and you will still be able to take your homeowner's exclusion, 250 or 500, depending on your marital status, off the top. Then the rest you can 1031 exchange it.
Oh, you said that 250 or 500 is joint.
Yeah,
That's a tax exclusion, right? That's what
Yeah.
you're referring to?
if you're single or if you're married.
Yeah, married.
Yes, then you'll be able to take $500,000 off the top. Whatever is remaining, you can 1031 exchange that.
Oh, okay. All right. So extended to your previous answer about it. For example, if I have a business rental property, so I bought it under LLC. So that's gonna be a joint that we have some certain percentage with my friend. So we form LLC, then we acquire this business property. Then we saw a pretty good capital gain. And since there's no time limitation, we can just do the 1031 exchange at any time. But if we ever want to split out, for example, from LLC to some other potential, exchange property that we're looking at, so can we change it from LLC to our personal name based on the percentage that we identified before?
Yes, you can do it, but I would suggest you do so at least a year before you sell, because the government is going to see that Tom, let's say Tom and Wei Ming, right? Let's say we're business partners. The Tom and Wei Ming's LLC is the owner of this property, and let's say we put it in our names tomorrow and we sell it in a week. Well, the government's going to say, well, Tom and Wei Ming, you've only owned the property for 1 week in your name before you sold it. The LLC was the previous owner, not you, not Tom, not Wei Ming. So if I want to do an exchange, if you want to do an exchange, we need to put it in our names 1 year before we sell.
Okay. Well, Okay, so may I know the reason for it? I mean, is this too complicated or how does government look at it? It's different.
It's just how the government looks at the transaction, right?
Okay,
Because
all right.
if it's you, if it's Tom and Wei Ming's LLC, the government sees the LLC as the owner and taxpayer, not you, not me, but
Correct.
the LLC is a taxpayer, right? If the LLC sells, no problem, LLC can buy. But if you sell, I'm sorry, if the LLC sells and Wei Ming buys and Tom buys, the government's going to say, why is there two new owners? You guys aren't the owners. The LLC is the owner. As long as it's two individuals who are not married to each other in the same LLC, that LLC is a taxpayer, not the individual. Now, if it is Tom and wife in LLC, no problem. They can
Yeah.
sell under LLC and then buy under Tom and wife name. No problem.
Got it. Is there any difference if I hold this property for a month versus over a year?
Yes,
Will the story change? Yeah.
ideally you want to hold it for at least a year to be safer. It's because 1 month is considered a very short period of time.
Okay, so I can do it after a year, right? So,
After a year, yes, sir.
okay, got it. Thank you.
Yeah, absolutely. All right. Any other questions? Okay. Well, if nobody has any additional questions, again, my contact information is on the page right now, and Jerry does have a copy of the slides. If you would like a copy, feel free to reach out to Jerry, and I'm sure he'll be able to forward you a copy. You can use it as reference. Thank you very much, everybody, for having me here today, and I hope everybody enjoys the rest of the week. Have a good day, everybody.
Mr.
Thank
Pong,
you.
last one. So just a recommendation, nothing else.
Sure.
So I think this is very helpful. A lot of people knows about this, heard about it, but don't know much detail about it. I think this is very helpful seminar. Do you plan, or does our company plan to invite you or someone in your entity then to present some more information, either extended of this seminar or any others interesting topic?
You can request that from Jerry.
All right.
Yeah, you can.
I
reach
just
out.
want to say it's very helpful for me. Yeah. Thank
Okay,
you.
absolutely. I'm more than happy to come in person too, if that's easier. So it's easier to ask questions, and I can draw out more examples. Yeah, I'll reach out to Jerry and his team and see if I might be able to put something together.
Appreciate it.
Yes. All right. Well, thank you, everybody, and have a great rest of the day. Take care.
Thank you.
Thank
Bye-bye.
you. Have a good day.